Hello, welcome to lesson 2. Please pause the video to read the disclaimer. In lesson 2, we are going to look at equilibrium, discount, and premium prices. We say the equilibrium is the midpoint of a price range or the midpoint of a swing that is taking in consideration a swing high and a swing low. It is the level at which an asset is neither cheap nor expensive. And this is not the level we are interested in trading or executing a trading from, right? We want to buy at a cheaper price, which is below the equilibrium price. And then we want to sell at a higher price above the equilibrium price. So when you take a price range, we consider the low and the high of that range. The middle point of that range is what we call the equilibrium price. Therefore, any price levels above the equilibrium price will be termed as premium price, and any levels below the equilibrium price will be termed as discount price. So at premium, the asset is expensive and should be sold. And then at discount, the asset is what? Cheap and should be bought. Now, this level can easily be identified by drawing your Fibonacci from a swing low to a swing high or a swing high to a swing low, depending on the kind of trade you're looking for, right? And so the levels above the equilibrium price. So first of all, what is the level for the equilibrium price? The equilibrium price level is 50% of the range. So a half of the range is what we call the equilibrium price. Anything above that should be between 61.8%, 70.5%, 78.6%, and 88.6%. Then these levels can either be in premium or they can be at a discount level, depending on how you draw your Fibonacci. So if you're looking for to pick a trade in the discount, that is to look for buys, then you have to draw your Fibonacci from a swing low to a swing high. And then if you want to pick a trade inside a premium range, right, then you have to draw your Fibonacci from a swing high to a swing low. Sorry. Okay. All right. And so we are saying that the advantage of using this is to help traders to pick trades at the best price, right? And I was narrating a story to someone, and I told him that when you go to the black market, not to the Forex Bureau, you go to the black market and you have $1 that you want to change into maybe another currency, let's say cedis, the Ghanaian cedis. We know that the rate of the dollar to the Ghanaian cedis is 1 to 5.7, right? 1 is to 5.7. So $1 to 5.7 cedis. Now, when you go there, the man at the black market who is usually an illiterate, right, would never buy the dollar from you at 6 cedis. That is, it's not going to give you any amount beyond 5.7. And so he will be bargaining to pay you below 5.7. So he may want to give you 5.5, 5, even 5.2, and even 5.0, depending on how you bargain, right? And this is how the forex market is supposed to be. Usually, we, the people who trade forex, buy at any price, we sell at any price. And so usually I tell some of my students that the man at the black market understand forex more than us because we do not choose the best price. And so if you want the best price, you don't buy just anyhow. How do you buy at premium? Already the asset is expensive. So why are you buying there? Right. So anytime price is at premium, you have to wait and you see that the trend is a buy trend. You always have to wait for price to come back into a discount zone for you to buy. All right. So this is an example of CADJPY that was retracing, right? The main trend here was a retracement. So let's consider it to be a trend. And then he gave us a stop hand. There was a stop hand. Anytime there's a stop hand, our eye goes toward the last low before the stop hand to look for breaking market structure. Eventually, price trades below the previous low and breaks the structure. So after this, we have this swing. This is the swing high. This is the high, and then this is the low. So we take our Fibonacci to we draw it from the high to the low, right? And then we get our equilibrium price and then the premium prices, because there's a break in market structure, you'll be looking for sell. And then remember from our first lesson that a break in market structure suggests that the market is changing direction, right? So it is stopping the previous uptrend and then resuming a new trend. And to join that, we said that we wait for a shift in market structure, which is usually a trend, right? Where we see higher highs, higher lows, right? And then we wait for a break in that shift in market structure. We take trade from the shift in market structure and join the main trend. Okay, and that is what we said. And so this lesson will complement that, right? Now, what we are going to do, or what you are looking at, is that since there has been a break in structure, right, a range has been created, so we can anticipate the price will move above what the equilibrium price and then sell. So in here, because this is an image, I don't have a Fibonacci tool in my PowerPoint to draw, right? So I mark the level. This is a 78.6, and a 50% will be around this level, right? So we want to take a trade at premium, and then premium, you should be looking for premium levels, right? For instance, when we go to lesson 3, we will know other aspect of other points or how to get perfect entries, right? But in here, I'm mentioning a fair value gap, which we've not looked at first yet. We've not looked at yet. So in here, there was a fair value gap, and so we can anticipate that if price is coming to a premium range, the best price to buy is around this area, right? This is the 78.6, and price trades into the 78.6, right? And then it fell, right? So what we could be anticipating if we're looking at this, could say that we have 1, 2, right? Back, back, and then there was a structure here, a breaking structure here, and then this is the shifting market structure. So first, in our first lesson, this is where we would have gotten our entry, right? And then adding this one to it, this is where we can get our entry, right? And our stop loss will be somewhere here or even here, right? So this is how the discount and premium is complementing our market structure, giving us precise kind of entry. But as we move on to the next lesson, okay, the thing will become clearer, and then you will see that, okay, because there's a fair value gap here, and that this fair value gap is in line with our premium levels, then I'll confidently take a trade here and set my stop loss at this level. All right. So let's look at this same CADJPY, right? Where are we? Okay, this CADJPY is my long-term setup. Think on a weekly chart, right? And then on the 4-hour chart, 4-hour chart first, right? In this small micro trend, this micro trend, right? We got a break in market structure here. Okay, so that gave me a confidence that since there has been a break in market structure, it will be hard, very difficult for price to trade above this point, right? Because we are seeing that in after a break in market structure, the shift in market structure is not expected to go beyond the new high that was created, right? So in here, okay, so we had a first break in market structure here, and then we have the bigger break in market structure because if you're looking at the main trend, the bigger trend, this was what we would have seen. 1, 2, 3, right? Right. So now we have a break in the bigger trend. So after the break in the bigger trend, we will be expecting a shift in the market structure. So this shift was occurring, right? This shift was occurring, and then we were watching it. So let's okay. So we can switch to a smaller time frame, and see what was actually happening. So on the 15-minute time frame, there was a shift in market structure. So this is a shift in market structure here, right? And inside the shift in market structure, we got a break in market structure as per our previous lesson. So shift in market structure, high taking, break. There was a break in market structure and this shift in market structure. And remember, the higher time frame break in market structure suggests that the market is going down. So this was what a short shift in market structure that has broken structure. So we have a break in market structure here. And now price was struggling to go up. Price was struggling to go up. So when we take a Fibonacci, to draw it from this swing high to this swing low, right? This is equilibrium price. We have 61.8% above it. We have 70% and 78%. And in here, we have a fair value gap. So, which means that if I go to a 5-minute chart on the same pair, right, I can easily take a trade and put my stop loss somewhere here. Okay, and then we have a drop. So we got a first drop, and the first drop broke market structure in this small uptrend, right? So if structure is broken, then again there could be what a shift in market structure. So we have a shift in market structure here. This one wasn't a shift because market structure wasn't broken, but this is a shift because market structure had been broken. So we can trade onto this candle, right, and put a stop loss just above this, and then wait for markets to fall. And so this is what we do. And remember, the confirmation is always that market structure is broken, right? You can go back to the 15-minute chart, right? And then we do something. Here, on the first instance, this is the range that was created. This is the range, the previous day's range, right? This is the range. We got our 70.8% retracement above the equilibrium price into premium. Then this range, right, becomes the next day's range, this one. So again, we can take a Fibonacci retracement tool, right? Draw from this high to the next high. Still be looking for, because we are looking for sell. The break in market structure suggests that it's a sell. So now we can draw and look for sell entries above the equilibrium price, and this time our price goes into the 70, but we need to confirm this level with other things, right? So you could be navigating to find a reason why price traded there. Now in here you can see that on the 30-minute chart, we see a fair value gap here, same kind of fair value gap here. right? If you go low, you may find an order block. And again, the next day you have another range. You can take a trade from that range, right? This is a range, and price went slightly above the 50% into again a fair value gap. Not too clear, but I know when you go to the 2-hour charts, we're going to see what an order block. So this is how it is done because we are going down, right? On the next day, you couldn't have found a better range, but again, in here and in here, okay, we have this swing high and this swing low. See how price traded into the 88%. So because it is a sell, you are always looking for sell trade above the 50% level. Okay, so guys, this is where the lesson ends, right? Bye bye.